Hi guys, welcome to Traders Talk, and this is Meng Hon, your host for the day. All right, this is Tuesday, and it's a great week to start our trading because this week is some big things happening tomorrow. Yeah, tomorrow is something big is actually happening. In fact, a lot of things happening every week. Yeah, and of course. Tomorrow is actually the Fed rate hike, right? Fed rate hike, which is actually expected tomorrow at 2 a.m. if not mistaken. Yeah. Let me just check. And over the weekend, more exciting news on the banking sector, right? If you follow what has happened the a couple of weeks, 2 weeks ago, right? 2 weeks ago, we started with some banking problems. Then we had some bank runs, and last Sunday, another bank went to see its demise. Right, Credit Suisse was actually taken over by UBS. UBS at I would say dirt cheap price, 3.2 billion. In fact, UBS actually wanted to take it for even a better bargain at an initial offer of 1 billion, and of course they closed the deal with the help of the what is that the Swiss central bank, right? To close the deal at 3.2 billion for a very bad bank, one of the worst bank ever, because the stock price before that was actually almost about $2 and of course yesterday itself, Credit Suisse came down to even one over dollars. Yeah, and with the valuation of 3.2 billion, I think probably it puts it as a penny stock, below $1, probably 30 or 40 cents per share. Yeah, per share. And of course, with this, besides the shareholders who would lose a lot of money, the bondholders of Credit Suisse bonds would also have their bonds all wipe out. Yep. So banking is actually one. I would say risky investment if you do not actually get on the right investment, or get onto the strong bank. Yeah, strong bank. And of course, because of the fallout in the banking sector, right? The Fed has actually came in and intervened and and bailed out some of those banks which failed last week, to avoid the contagion of more bank runs. Yeah, and of course, for those people who actually keep money in especially in the US, right? In these regional banks, I think a lot of them have already shifted their money, or trying to actually shift out their money out of those banks to avoid the risk. Although the Fed has actually came in to bail them out, right? I mean, if you had money in some of the smaller regional banks, you would also try to actually take them out and put them into larger banks. And of course, the irony is that when that actually happened, a lot of people put their money into larger banks like Bank of America, maybe JP Morgan, or even Goldman Sachs, right? What has happened is that these bigger banks, who actually has had a flush of incoming flows, right? Incoming flows to their bank, has actually on lend this money back to the regional and smaller banks to actually provide them with liquidity. Yep. So it's just like you thought your money was safe, you put it in a big bank, and basically the big bank has actually taken your money and put it back into the banks probably where the money actually came out from. Yeah, of course, this is actually to maintain the banking sector as an overall, so that it does not cause a domino effect, one bank after another one, right? So basically that was actually what has actually happened in the last weeks. Yeah. Okay. So of course, there is actually good and bad of what has actually transpired. The good thing is, of course, it has actually probably we won't know until tomorrow where the Fed rate hike is actually announced, right? But the market consensus is that because of this, right, it will probably result in the Fed to ease the rate hikes to put less pressure into the banking sector and the overall economy. And of course, how to say, that was actually what the Fed actually wanted, to actually put pain to the economy, right? If you actually recall many statements where Jerome Powell was actually saying that the rate hikes that they had actually done for the past year, right, will actually inflict pain to the economy, and that is actually their target, so that they actually bring down inflation, right? But of course, what has actually happened is that the initial pain came a lot to the services sector, especially the tech sector. Yep. And for the past years, you actually see a lot of corporations and big companies, right, to actually start to trim down their spending, to actually cut headcounts and all. Yeah. And that has actually brought down the overall tech sector by at least 30, 50, or even more for a lot of companies. But of course, the results actually came to an area which probably the Fed also did not expect, which was actually towards the banking sector. And I would say this is probably not a direct result, is probably also because of some stupid management by some of the banks, like the SVB, right? Where they had actually taken decisions to take the depositors' money to actually place it on long-term bonds, which actually gave them lower returns. And of course, when the rates actually started to increase, right, what they were actually getting from the bonds were much lower than the short-term rates, which people can actually get from short-term treasuries. Yep. So, and of course, because a lot of people were also taking money out from the banks, they don't have enough money. They have to liquidate their bonds, which also came down in value, and they had to actually take large losses, and this actually caused problems on their bank, and they had a bank run. I would say it's accidental. It's accidental, and it's not intended. But the Fed just had to actually solve the problem, and the way they actually solved the problem was to actually flush back some funds into the banking sector to maintain stability. Yeah, and of course that also took a big part of what action they have actually tried to do for the past 1 over years, right, to actually contain inflation. Okay, so of course, going forward, the expectation on these rate hikes would ease down, and earlier the rate hike, which the market consensus was actually probably between 25 to 50 basis point, more towards 50, and because of all these issues coming here, then the expectation is that it will actually run down back to 25 basis point, and if we are lucky it would actually go down to zero at the next one. But I doubt it would actually be zero, probably still 25 basis point. And of course, post that, the May, there's actually another meeting, and of course, at that point in time, the is going to be either 25 basis point or probably zero if things get worse, right? Get worse, and of course, uh, that would how to say, bring a lot of ease back to the tech sector, because tech sector is actually more sensitive towards interest rate. And of course, once the interest rate hike stops, then of course that would actually start to give less pressure for the tech sector, and from there on, when the QE starts again, that means the interest rates starts to actually gets cut to reduce. Then of course that would hopefully bring back the tech sector up. Yep. So title for our show today, Bank Save the Tech. And that's basically the story. And of course, within all these mess, right? Mess and problems, right? Are there actually real opportunities to play in the market for either the banking sector or the tech sector? We can actually probably see. But of course, the tech has already rallied, right? Since this has happened, which we can also see from some strong movements in blue chips like Apple. Maybe we can actually see here. Here, maybe you can actually share and see what were the effects for the past weeks on tech. Okay, what were the effects? Let me make this smaller. Yeah. Okay. Where is tech? Tech, yeah, you can see tech, right? Okay, tech. Don't do one day, because yesterday it was actually a green day, right? 1 week performance probably. Okay, okay, 1 week performance. Okay, you can see that tech is all green, yeah, all green here. Tech, communication, and then what is actually worse? Banking, right? Where's banking? Energy, railroads. Financial here, yep. This is actually financial. JPM down, BAC down, Wells Fargo down. Yep. Okay. Yep. Okay. So yeah, I mean this has helped tech a lot in terms of this sector and this sector, and of course Apple has a very strong rally for the past few weeks, and of course these are also one of the so-called I would say safe havens, right? I mean, rather than putting your money in a bank that is actually not safe, right? Not safe, right? I think some people would probably shifted their cash into securities. At least they own something, I mean, they own something in securities. That's why you see Google has rallied 11% for the past week. Amazon 5.7, Apple 4.6. Meta also 9.3%, and Microsoft 7.2%. Yeah, the only one which actually started to actually come down is Microsoft, and yesterday Microsoft had actually gave back some of the gains, and probably later we can also see the charts. Why has that happened? Yeah. Okay. All right, so this is the tech side. Okay, so I would say tech side, they would have rallied a bit. Of course, if you actually want to go in right now, I would say it might be a bit too high. I mean, a lot has already moved up. Yeah, the only sector which if you dare to actually enter right now, still which has still came down because of all these problems, is actually on the banking side. Okay, we'll catch that shortly, and let's see the S&P. Where are we this week? Okay, this is actually day. Okay. Okay, last week we had actually quite a strong rally up, right? I think practically the whole of last week, S&P has actually bounced up a lot, mainly the from the time where the Fed actually came in to save SVB, right? Then of course that actually gave a little ease to the market, and from there S&P has actually recovered, and only on Friday last week it actually gave up some of the gains, and of course yesterday again it had actually moved up by almost 35 35 points or close to 1%. Yeah, and of course this is again coming back to the expectation that the Fed is probably not going to do a high rate hike, probably 0.25 25 basis point, and as opposed to earlier expected that they will even push it to 50 basis point. Yeah, because on the inflation side, CPI, which was actually reported last week, we were actually still at 6%, although on is still on the mark, what was expected, right? I mean, 6% inflation year on year is actually still a high rate and far from the expected 2%, which the Fed wanted to target. Yeah, wanted to target. Okay, so again, S&P is actually coming back to the levels here, and I think we did mention many times the S&P is actually expected to S&P 500 is actually expected to bounce around between these level here 3,008 to 4,000. Yeah, 3,008 to 4,000 points, and of course once it actually breaches any of these levels, right? Any of these levels, then we can actually see probably the next move, either up or even coming down. 3,008 is somewhere around here. 3,008, yeah, somewhere around here. Yeah. So these are the levels. Yeah, these are the levels. Okay. And if you look at Nasdaq is even more bullish, right? Nasdaq is even more bullish than S&P, mainly as I said, because of the lower expectation on the rate hikes, right? And the higher they actually go, the bigger problems the Fed will actually put themselves into, like what has actually happened right now, and you can see that for the past week, and the Nasdaq has actually gone up from the past week. Let's put a week here, right? It has actually moved up by about close to 6% within the past week, and of course the levels which we need to actually see is like this 12,000, somewhere around 12,800 levels here. Yeah, the previous high. And of course, on the support side, basically you are seeing that the 200 weekly moving average is actually forming also one good support level, and this is basically at around 11,700 points. Yeah. Okay. Okay. All right. So let's yeah. So that's S&P. I would say positive news. Positive news. Market is actually good, right? Low interest hike is going to push the market much higher. Yeah, in fact the Nasdaq today has already gone up by 90 points, and S&P futures 32 points up. Yeah. Okay. Okay, so yeah, I mean, like I said, some of the stocks which on the tech side, right? Tech side, Apple, wait, not moving. Let's see, hang. Stop sharing. My Chrome have actually hang. Let me restart. Oops. Okay, the Chrome, the browser actually hang just now. Okay, we are back. All right. Okay, let's just look at some of the stocks today, both on the tech side and also on the banking side. Like say, Apple has actually rallied up very strongly back to the earlier high levels. Yeah, of course, watch out that these levels was actually the previous high. You can see that it has never breached above 15780 or 15 around 15 about 15780. Yeah, many times it has actually not managed to actually breach it. 1 2 3 4. Yeah, and of course, I would say in the past weeks, this is 5 minutes, 1 day. Let's put 1 day. Okay, this is the daily chart, right? Okay, daily chart, and you can see Apple 1 2 3. Yeah, is actually around the highs, at the moment. Yeah, at the moment. That's why I said it. If you actually want to go in, then of course it is actually a level which is probably a bit high right now to actually do an entry on tech stocks. Okay, okay, Netflix. Okay, Netflix is a different story, right? Netflix. Okay, and of course, if you actually follow Netflix, they actually change some of their subscription models, and also they have actually put in advertisements into some of the lower price models, and of course this has actually worked out quite well for Netflix. Yeah, and although during this time where it has hit together with the overall market, it has actually taken a hit, right? Then of course you can see that at the level of about 290, it actually stopped going down. What's happening here? It actually stopped going down here, and of course right now it is actually starting to see a reversal. It might possibly actually go up because of the positive news regarding its subscribers, and also the ad supported subscriptions, which the market is actually quite positive on. You can also see that the news here, right? Here is still a sell even as a ad supported offering. Yeah, but of course, watch out for this this stock. Yeah, this stock, it may actually recover up a bit. Yeah. Okay, and of course, this level is the support level on Netflix, about 280, around 280, 285. Yeah, 285. Yep. So like I said many times, right? I mean yeah, I mean, however bullish a stock is, right? However bullish a stock is during times where there are a lot of news flows, some of the movements can tend to be temporary. Yeah, temporary. And of course, like I said, I would tend to actually take profits quite early nowadays, and of course, even reduce the trading time frame, right? Trading time frame from doing option swing trade to actually day trades. Yeah. And Netflix is actually one of the stocks uh, which moves quite a lot intraday also. Yeah, you can see intraday trades for Netflix is also quite big movements every day. Here is 296, and it went to 307. So basically, you can see that yesterday itself, right? Yesterday itself, $10 move up, right? $10 move up, and basically from 307 coming down to 301, another $6 movement down. Yep. So if you are able to actually catch this kind of strong day movements, right? I mean, it would actually be a good quick day trades in and out on stocks which has actually big movements like Netflix. Yeah, and we tend to actually move how to say look at the stocks of like Netflix together with the overall market, right? For example, this is Netflix, and then this is SP, as let's say SP uh, X, yeah, SPX. Yeah, we tend to actually look at these together within the same kind of day trade time frames. Yeah. Let me see. This is 18. This is 21st. How come it's 21st? Mm, hmm? Okay, SPY. This is 20th. This is 21st. I think yesterday is here. Yeah, yesterday is here. Okay, so if you look at the movements for, say, for example, Netflix against market, right? Against market. So basically, this was yesterday on the move up. On the move up for Netflix is also going up together with the market, and of course on the move down, it also goes down together with the market. So a bit more correlation in terms of the stock movement against S&P. Yeah. So on the bullish day, reversals, going back up. Yeah. So this is how we actually also look at the so-called day trade time frame movements together with the overall market. Yeah. So of course, if today is actually a bullish day, then of course, highly possible that stocks like this would also rally up. You can actually see again, Netflix pre-market is already up $2. And as I said earlier, the S&P futures is up by 30 over points, right? 30 over points. Then you can see Netflix is also positive. Yeah. So tech stocks, besides this, of course, other tech stocks, Visa, Visa has actually came down. Let me put this out. Visa has actually came down, right? So from its high of 220 now to 218. Yeah. What stocks I actually wanted to see? Bank stocks, Goldman Sachs. Yeah. Okay. So don't do the first okay, Goldman Sachs. Okay, Goldman Sachs actually came down about $70. Yeah. Goldman Sachs has actually came down about $70 during February itself. And of course, one of the levels which we are actually watching is for it to actually even come down to this 289 or 290. 289 or 290 level. In fact, it did not come down here. And of course, yesterday itself, we do see that it has actually bounce up. Yeah, bounce up. Of course, if it does not reach this level, and it can actually continue to go up, but you want to actually trade this level because you feel that this is actually a level where you can actually find safety or support, then of course you can actually go to strategies like if your account is big enough, selling a short put, a naked put, and of course this is a $300 stocks. Yeah. So if your account is not big enough, I would not advise you to actually sell a naked put, but of course you can do other defined risk strategies such as doing a bull put spread, uh, at levels where you can actually find strikes at 280, 290 and below. 290 and below. If you can find strikes at 290 and below, then of course you can actually do it. Let me check GS, right? GS IV rank is actually quite high, about 74. And of course, if you do, let me just change the screen. Maybe I share it with you guys. GS, stop sharing, share screen. Okay, so this is Goldman Sachs, right? Goldman Sachs IV rank is 74. Earnings is actually coming out on 18th of April. Okay, 18th of April, you still have about 20 over days, right? Yeah, about 20 over days is okay, about 28 days, 28 days. Let's say if you actually want to do a bull put spread on Goldman Sachs, what is the level which we can actually do? Put it to 38 days, 28th of April, 28th of April. We can't do the monthly anymore because the monthly is 21st of April, which is 31 days. Uh, it's too short. I mean, either you go to 38 days or 59 days. Yeah. So let's just try 28 days, see what we can actually get. The expected move is about $27. So currently is 309. So basically you are talking about around $281. Yeah, 281. And where is the level of support? Just now we saw on the chart, right? The chart, the level of support was actually at 290, right? 290. Yeah, just right. Two. This is 280. Yeah, 290 is the support, and we are actually talking about doing this at about 280. So it's actually below, even below the below the last support level, right? 280. And let's see if you actually do this is 18 delta. Yeah, you can see delta here, 18 delta, and the $5 with strike, you can actually get 83 cents. I would say it's the premium is slightly low. Yeah, the premium is actually slightly low. And of course, if you are just doing a bull put spread, basically we are trying to actually achieve at least a dollar here, for a max risk of about $400 here, $400. So this is actually about 83. Then of course, at 20 delta, we can actually move it up a bit to see if we can actually get that. Yeah, so okay, you can actually get it at 21 delta, and this is actually at exactly at the dollar. Yeah, at a dollar. 285 still below the support, the last support of 290. Yeah, you still have some buffer for 1 month to actually go past by. Of course, anything can actually happen back to the banking sector, right? Things can actually become worse. But whatever worse that actually comes, right? Since the Fed has actually wet their hair. When we say wet their hair means in Chinese, there is actually a proverb where you actually wet your hair. It's already wet, right? So you tend to already be in the game. If you are actually saving the banks, right? You need to actually try to save whichever banks that fails after this. Yeah, after this, then you can't say, oh, I want to save this bank and subsequent another bank collapse, right? You say, I don't want to save that bank. So what is the rationale for you to actually do, right? That earlier you did at one action, and now the same thing happened, you actually don't want to save the thing. So I would say there is risk, but of course, it from the actions, it may be how to say, it may be less prone that any of the governments would actually let their bank fail, right? I mean, you can see the US government has helped their banks, the Swiss government has helped their bank, and of course, the next one, if you're talking about other governments like the German governments or the French government, BNP, right? I mean, there's also talks that BNP is also having troubles, right? Then, of course, if that happens, then if the French bank comes in to help them, and if the German banks like Deutsche Bank or Commerzbank fails, then of course the German government might come. Then it's all governments saving their own banks. Yeah. Then of course with that, hopefully these bank stocks which has actually crashed, right, would actually have some recoveries going forward. And with this, then we can actually do some trades off the current situation. Yeah, current situation. Anyway, the risk The risk is $400 for a $100 gain, right? And of course, the IV rank is actually also quite high at 74, and the IV here is actually about 40, 41. Yep. So this is one play which you can do if you want to actually give yourself a bit more of time, right? Then of course you can actually even move it to 19th of May, and you can actually do 280 itself, 280, and this is actually 98 cents. Yeah, you can actually do 280 instead of 285, but of course you are actually lengthening your the duration of your trade by by uh, here is 59, right? Just now was actually 20 30 38 days to 59 days, but bear in mind earnings of Goldman Sachs is actually coming on 18 of April. Yep. So this is one. Of course, Goldman Sachs is actually a much more expensive stocks. We can actually look at other stocks which are actually cheaper. And let's see if we can actually find any cheaper bank stocks to actually trade on. Mm, let's see. Trade. Okay. BAC. Okay. BAC, Bank of America. I'm only picking up strong bank stocks. JP Morgan is also one. JP Morgan is also one. Yeah, JP Morgan here. This is JP Morgan, and JP Morgan has actually came down from a high of 144. This is one day, right? Okay, 144. Now sitting at the 200 moving 200 daily moving average here, 200 daily moving average here, and today you see the bank stocks is all going up. Yeah. Yeah. So yesterday was a great time to actually put on some bank trades, but of course if you are actually doing credit spreads, right? Credit spreads, then of course 1 or 2 days late is still okay as long as the direction of it is still intact. That means basically if it's actually going holding support, right? It's actually holding support and moving up, right? Yeah, it's still okay to actually enter into a credit spread, because your target is actually for it not to further go down below the level of your strikes. For example, just now was 280, right? Whereas this Goldman Sachs was actually trading currently at 309. So you have a 27 or $28 buffer, which is around 8 to 9% buffer for it to actually fall further before it actually hits your short strike. Okay. So where is coming back to BAC? Yeah, BAC. BAC. Okay, BAC is only $27. Okay, not a very expensive stock. So if you actually want to play BAC, is also okay. You can even do more aggressive trades. For example, using naked puts as a strategy, strategy. And of course, let's see where BAC price is right now, right? Okay. Of course, all the bank stocks has actually came down here since the last year, right? All the bank stocks has actually move down, and it's actually coming back to the lows. COVID lows is actually somewhere here, right? About $18, right? Okay, so this is like another opportunity, right? Another opportunity for it. I mean, it did not come. It's only now at 27, 28. So there's another $10 for it to actually come down. And of course, I don't think you would have the chance to actually get it at 20 again, because the Fed has actually put a stop to the for now lah. They have actually put a stop to the contagion, right? Contagion, and as much as it wants to fall from 37 to 27, right? So basically, you're talking about around 20 over percent, 20 over percent. Yeah, this falls since February, right? And since the so-called banking outbreak, right, it has actually fall from 34 to 27 here, 27 here. Yep. So this is the outbreak drop. Yeah, and yep. So the only way for you to actually get a lower price, right, is to go on more aggressive trade structures like naked put. And how do you actually do that, right? At which level you actually want to do that? I would say this level, right? This is one level of about $25. $25. If you can actually find any strikes at $25, then it is still okay to actually enter into a trade, a naked put trade at $25 or lower. If you can actually do it at this level, right, at this level of about 23, even better, even better. Okay, this area is one area which is a bit there's a bigger risk if you actually trade around this area, right? This area here, okay. Because you see what happened in this area is that from the price here to here, right? I mean, this is actually way back to November 20th, right? There's actually a gap up at this level, right? So basically, if the stock actually falls down, right? Yeah, there's no so-called no long-term support at these levels. Yeah, it can actually go straight all the way down to straight on to 25, right? Because there's nothing. It's like a void here, like it's like a void here. Yeah, there are no trades around this price here. Yeah. Okay. So you can see what kind of premium, what kind of risk and reward we can actually get. So now it's about $27, $28, right? If we move to the platform, right? If we move to the platform, what can we do with? Where did the thing go? Okay. All right. Yep. BAC. Okay. BAC. Okay, so this is BAC, yeah, BAC, and let's see. Earnings is 18 April again. All bank stocks earning 18 April. Okay. IV rank 82 which is actually quite high, right? Quite high. And how come BAC? There's no okay. BAC IV is 54. 4-star, very liquid stocks. Very liquid stocks. Okay, so BAC, like I said, what you can actually do is more aggressive one because the stock price is only at $27, right? So if you're talking about even doing a naked put, then basically you're talking about 2,700 if you are fully securing it with cash. Okay, let's say 50. Let's put it at 28, 18 April. 28 May 59 days, which is basically 2 months lah, 2 months. And just now we were actually talking about a price of about 25, right? 25, right? At 20, between 23 and 25. We're actually wanting to find something between 23 and 25. Okay, so you're talking about 19 May 23. Basically, you're talking about delta 15 61 cents. Yeah, so if you sell a naked put, you're actually getting 61 cents for 23, which basically gives you 0.6 divided by 23, which basically gives you 2.6% return. 2.6% return for 60 days. 2.6% return for 60 days. Because you are actually going for a lower delta of 15, right? Which you have 85% probability of it not getting in the money, right? Not getting in the money. That means this is a highly probable trade, and you give up some of the premiums. If you actually want to be more aggressive, to move up to $25, which if anything happens on worst happens on the banking, easily BAC can actually drop down to $25. So I would not go for that. I would not go for that. Either I get less premium if I actually want to do a trade, or I do something which basically have less less risk lah. I mean, I would actually use this 61 cents to see how I can actually finance a double direction trade. For example, I get 61 cents here. I can actually do a bull a bull call spread, and maybe 28 and 30, right? 28.30 bull call spread. What do I get? 28.30, I need to actually pay 95 cents to do a bull call spread. And if I actually use the 23 to finance this bull call spread, I would actually pay only 32 cents. Yeah, I will actually pay 32 cents to actually get a max profit of $168. $168. Yeah. So 32 cents max profit, $168. The buying power is only about $325. And if you use buying power to calculate your return on investments, right? Basically, you're talking about risking. You're talking about getting a return of 50% against your buying power. Yeah, against your buying power. Okay, lock buying power, 168, 50%. Yeah? You can actually do one of these trades. Okay, and of course, one of the other ways to actually trade this is actually also on a longer time frame, and of course, 60 days may be. You might say maybe 60 days is actually something too short to even see any significant changes or improvements in the overall banking sector, or maybe even overall economy. And you already know that um, uh, the next hike is tomorrow, subsequent in May, and possibly after that they would actually go on to stop the rate hike, maintain it at that level for a duration before actually cutting back rates down, maybe towards the end of this year, or even crossing over to 24. Okay. Of course, when that happens, and if the US economy don't go into a recession, then of course that would actually be positive to the overall economy and overall stock market. Then you would actually want to put in a trade on a much longer horizon, taking the opportunity of this current down move. Yeah, and to trade probably crossing over to 2024. Yeah, 2024. Then you can actually do a longer term trade to say that crossing 2024, you need to actually pick the nearest is actually January for now. Okay, and after January is June. Okay, I would say in January is probably neither here or there, because if they push the rate reduction crossing over to 24, then of course the more positive news would actually come after January. Yeah. And of course, if you actually do 21 June, I would say is again too far lah. Too far lah. Unless you want to put in a trade and just sleep, then it's also fine. But if you say if it is no longer than a year, right? Because that actually goes more than almost 1.5 years, right, to June. And there is actually about yeah, that's about 15 months, right? So let's say January. What can you do in January? Okay, what can you do in January? For example, you can just take on this 20 put, for example. 20 put, which is basically you're getting $1 for 20 divided by 20. Okay, So you're talking about making a return of 5% in 304 days, and just put it in less than a year, lah, slightly less than a year. So basically, it's about how many months? 10, no, 9 months, about 9 months, yeah. So to get actually 5% return in 9 months is actually not too bad, not too bad. And you are actually talking about $20. And if you look at the BAC, $20 is actually coming back to around the COVID lows. Yeah. So if BAC don't go bankrupt by January 24, then it is actually a really I don't think BAC will go bankrupt. If BAC bankrupt, then all your other stocks will probably also die because the US economy will probably go bust. Yeah, so you're talking about taking 5% return on this trade for a year. Sleeping, you don't need to trade daily. Is also quite good and safe returns, right? So you actually do that with this. Okay, so that's actually one very simple trade. Okay, and of course, if you actually want to do beyond that, you can also mix it with some bullish debit trades, similar to what I have actually shown you earlier. Is actually, let's say, 28 and 30, for example. 28 and 30. Okay, so 28 and 30, you're talking about buying a bull call spread, 20 strike 28 and 30. And this is really a long term one. And basically you are not even paying anything for this. Are you paying? Yeah, you're not even paying anything for this because it is actually on the net credit side, net credit. Yeah, net credit. So net credit, because you get paid 9 cents to actually enter into this trade, as long as BAC at the end of January 1924 don't fall below $20. Yeah, the 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 worst you can get is get these nine cents, get these $9 into your account. The worst you can get is $9. Yeah, if the price actually falls below 28, then of course this bull call spread will actually become worthless. It's only this part where you actually make the 106 offset with the debit paid, right? For this, then of course you get 9 cents. Of course, the other side, the max you can actually get is a profit, as long as uh, by January 19, this stock price is actually above 30, right? Above 30, then you're actually getting a profit of 209 against your buying power, which is actually locked in this account of $300. $300. Yeah. So your return is basically about 66 or 67%. 66 or 67%. Yeah, return lah. Yeah, return. Yeah. If you are actually comparing with the buying power block, if you actually want to compare it with this what is that, this max buying power of a cash secured, right? Then you're talking about 209 divided by 1991, which is about 10%, which is about 10%. Yeah, it's like double the rate which you will get from a naked put. Yeah, only double the rate which you can get from the naked put lah. Yeah, if you're actually comparing to the uh, max loss situation of BAC going to down to zero. Yeah, but as I said, highly not likely. So sometimes when calculating, I also don't look at the risk and reward based on this max loss figure. I would tend to actually also see what is the so-called buying power block in my account to actually trade this strategy. Okay, so this is a more longer term trade. If you actually feel that BAC will go even higher than 30, right? Because now it's already 27, so it needs to actually move only $3 to actually go up to 30. Yeah. So if you actually think that it will actually go more than 30 in 1 year time, then you can also move the strike up. Just now was actually $5 width, right? You can move the strike up 30, 30, 35, right? 30, 35. Then of course this trade you will actually this is 28.33. Okay, so this is $3 wide. Okay, $3 wide. And if I do 30, 35 is $5 wide. $5 wide. Okay. And of course, because it's $5 wide, then you need to actually pay 56 cents to actually enter into this. But your profit goes from 198 just now, right? 198 just now. No, yeah, just now was 398 just now. Was it 398? It moves up to, let me clear this, 20, 28, 33, right? Yeah, 398, sorry, 398. If you do it here, it will be about 440 something. Yeah, I would not go for this. This is actually quite okay. This is also $5 wide, right? $5 wide, 398, 398. And how come the price change just now was getting 9 cents, right? Did I change anything here? Hmm. Just now was 9 cents, right? We were actually talking about 9 cents, right? 20. Yeah, oh sorry, 28.30, right? Just now we are doing 28.30, 9 cents, 28.30, 9 cents. 209 just now was 198, right? So 209. So if you do a wider one, which is $5, we need to actually pay $1 for this. Yeah. If you actually want to do double up this 1 to 2 is also possible. That means you do a two naked put to finance this site is also okay. Then you will actually do a $5 wide, increase this from close from around 200 to 500. 500 max profit, and what BAC needs to go up is only $6 within the next 340. Yep. Okay. All right. Yep. So there's many strategies which you can actually apply. It depends on what kind of expectation you actually have on the stocks which you trade, and basically how to actually use options, different option strategies to actually enter into the trade. Yep. If you want easy one, then of course some of those which I shown you on the longer term one, you can actually do. But don't need to look at those. If you do a longer term trade, right, you don't need to look at those every year lah. Whether it's actually coming up or going down, right? It's actually coming up or going down, right? You have a year for it to be correct. Yeah. And if you are someone who don't have a lot of time to trade and to look at this, right, then basically by entering into strategies like I said just now, just a simple short put at $20, you get 5% return. If you actually want to get a higher return and you're willing to not to get even any return from your capital, right, to a higher return of 10%, then you can actually do the other one using the naked put to actually finance the what is that, the bull call spread. Or of course you can also do more aggressive strategies, like doing a synthetic, which is basically uh, uh, using options to actually form share purchase. Yeah, for example, if you are actually doing a synthetic, means that you can actually do sell a put and buy a call. Yeah, sell a put and buy a call. You can even move it to a lower price. That means 106. If you buy a at the money call is $28, right? Then of course you pay 274 to actually control 100 directly to control 72 shares in BAC. Yeah, we follow the delta. Yeah, we follow delta. That means basically with this trade, right, selling a put at 20, buying a call at 28 for 304 days, right? For $274, you actually get to control the movement of the stock of 72 stocks. If you actually buy 72 BAC stocks today, right, by paying $28, right? 28 times 72, right? You'll be actually paying $2,000, $2,000 to enter into this trade. Whereas if you actually use options, your block buying power will only be $580, $580, and you get to control 72 shares, 72 shares here. Yeah. If you want to do it uh, finance more, then of course you can do you can do two puts to buy one call is also possible. Then of course you reduce the amount you buy at $166. Yeah, but of course your risk and your buying power actually also increases. Yep, many ways to actually skin the cat here. All right, so that's some of the examples of strategies where if you call this an opportunity for you to actually go into banking stocks. Yeah, if you call this an opportunity to go into banking stocks at a lower price than what it is actually currently trading, then of course some of those things which I have shown you are strategies which you can actually apply in crisis like this. Okay, so crisis doesn't how to say doesn't happen for long. Besides things like Ukraine war is over a year, right? I mean, banking crisis like this tend to be short-lived because the government cannot let crisis like this kind prolong. Yeah. All right. So that's all for today, and of course, hope we actually continue to actually get some bullish momentum in the market today until we hear from the Fed on the rate hike tomorrow. Tomorrow should be about 1 or 2 a.m. Yeah, trading starts 9:30. In fact, we are so used to trading starting 10:30, right? Yesterday I was actually relaxing until 10:30, and until I saw it, how come the market has already started at 9:30? So after many months trading at 10:30, right, you tend to actually get used to the 10:30 time. Yep. All right. So have a safe trade this week, and we will catch up with you. Don't forget to read what we had issued on our options newsletter, and of course don't forget to like and share our show and also our newsletter. Catch up with you guys next week. Bye bye.